Finance Committee regular meeting. Can you take roll, please?
Chairman Reinhardt.
Here.
Vice Chairman Hoagland.
Present.
Member Streeter.
Here.
Member Brooks.
Here.
Member Iglesias is absent.
Okay, thank you. All right, if you can take a minute and review the minutes if you haven't done so already. I'll give you a few minutes to review them. If you've had time to review it, if there is no questions or concern, the chair will take a motion.
Propose that we accept it as such.
Chairman, one moment. Ms. Iglesias is downstairs. She's coming upstairs now. If you want to give it just a moment.
We have founding and such.
Chamber funding is.
Okay. I didn't want to bring it publicly.
No, that's fine.
Oh, she's
Thank you.
all the hundreds and hundreds and hundreds. Dawn? Where's your picture? Yes.
I'm not gonna find out till September. Yeah. There's over 3,000 people there taking the exam, so it takes a while to get through all that.
We're currently reviewing the minutes, so if you could look over the minutes, because we'll be taking a motion. So if you can just glance over them, I know you weren't here, but if you can just review them, and then we'll proceed from there. We're starting our first meeting already. So we're following in the agenda. At the very top, you'll see a number 1. That's where we're going to be going from. All right, hopefully everyone's had an opportunity just to review the minutes. If there's no questions, Chair will take a motion.
So we accept the minutes as been prepared?
A recommendation for approval. Do I have a second?
Second.
Second. All in favor, say aye.
Aye.
Any opposed? Passes unanimously. All right, before we get started, since we have some new members, I'd like just to, we can go around the room and just do an introduction for the newer members. If you can just kind of tell us who you are, a little bit about yourself, and then we'll just go down the line. We'll start on this end. Let's go down the line so at least we know who's who. Okay.
My name is Selena Iglesias. I'm new to the committee. I've been in St. Cloud for about 5 to 6 years. I'm a broker owner here in St. Cloud. I do mortgages, refinances, and I own a processing mortgage company, so I know a little bit about books and stuff. So I'm looking forward to collaborating with you guys.
Thank you very much. Appreciate you.
My name is Dawn Streeter. I work for Help Now Osceola on the legal team.
Awesome. My name's David Reinhardt. I'm the chairman of the committee.
Boyd Hoagland, I'm in charge of Vice.
Alex Brooks, I've been living in St. Cloud about 34 years now, and I'm an electrician, but I was in Walt Disney World Finance for about 15 years, 30 years total for that company.
Well, welcome to all of you. This is going to be a way to jump into the experience of the Finance Committee is right into budget. But that's okay. I think we've streamlined things tremendously, and it's going to be a process of 3 meetings versus our regular budget meeting. We have 4 of these a year, basically. Just a couple rules for the new members, because it happens occasionally. If you have to miss a meeting, I would definitely call ahead of time, call and let us know, number one. But if you miss 2 meetings in 1 year, you basically have to, when you come to that second meeting or wherever the next meeting you come, you're not a voting member. You have to then explain why you missed twice out of the 4 meetings in the year, and then explain yourself. And then if we have to vote to accept you back in, and this is just a process that we do. It's happened to me twice. And it was, one was 364 days, basically. They missed their second meeting, and then they couldn't be a voting member, and they had to explain, hey, this is a voluntary committee. I was out of town, I was doing business, I was sick or whatever, but we've had members that you guys are replacing I don't even think called or let us know, so.
Those instructions are also in your bylaws that I emailed to you with your initial welcome letter,
Yeah.
just in case so you can look back on them.
Yeah, I
It's just to
read
give
those.
you guys, it happens, but I think if you call, let them know, they'll let me know, and we can, hey, you're gonna miss it, you miss it. If you're gonna be late, you'll be late. Everything should be fine, but still, even if you miss a meeting with an excuse, I was shocked when it first happened, and so we had to vote the person back in and go through the whole step. So that's just how that process goes. The rest of this, as we go along, if you have a question, just, excuse me, I got a question, and just speak up. We are an advisory board, so we're the checks and balances. So when you hear something like, I don't understand that, and just ask. And when we get into the budgets and stuff, and you're like, that doesn't make sense to me. And then if we have to, I don't know what, Wendy, what are we going to do when it's something that you can't answer for us? Because we never had a meeting. I've never had a meeting where there's no directors. So if I have a question, hey, chief, where are you at? Why are you going to Las Vegas with 12 of your men? How do I get an answer?
For the budget meeting? The directors will be here, sir.
Oh, they are going to come?
Yeah,
I
they
thought
are
you
here.
said they're just not, so they're not going to speak. They'll
They
just,
do not speak unless, like, there's something I can't answer for you. I try to be a scholar of the budget and guide us through and get us home, but in the event you need to ask operationally what's going on, or a little bit more detail, then we'll call them up, city manager will
so,
call them
okay,
up.
so we are going to do that. I thought you
Yes.
said we weren't going to.
No, referring to the 420 is what you asked him.
Yes, it's just the 420 that we were not going to have
And
discussion
we'll
on.
discuss that.
Yep, and I'll give you the preface, but you will have directors here, they'll be here for the second meeting. Like I said, I will guide you through the budget, keep you at a nice hovering level and everything, but if we see something that I can't fully answer, then we'll definitely call the director to share a little bit more as to maybe more of the operational direction on that, because they'll know their business better than anybody, so
Perfect.
you'll have that. Mhm.
So don't hesitate. If you hear something or you just like, and you're reading and she's going through it and I was like, that's a huge increase. Why last year? Because we had an issue where they hadn't spent money, we'll just say it's $1 million, and now they're asking for $3 million. And so we're like, you haven't even spent this, but then they had to explain there was a lag and everything. So just, if you see something you don't understand, don't hesitate to just ask. And I'm always open to that. They're very open and receptive to anything we need. And then as we do this process, and again, you're brand new to this, I really would like to see this in a meeting. Could I see a graph or this? If they're able to do it, they'll do anything that, within reason, that anything we've ever needed. They've changed things up because members like, hey, can we do this? Can we do that? And they get it to us. So, like sometimes the minutes, before we'd go 3-4 months and like, what did we talk about? And we didn't remember. So they would send us the minutes just so we can be refreshed ahead of time. So if you see things that, and again, I know you guys are brand new, jumping into the process, but we'll work our way through it. I think it's going to be very smooth now and streamlined, but any questions you have, anything like that, we'll walk through it. All right.
Okay.
Enough with that.
And I just remind everybody, I'm a former Marine, so I go slow. And don't you worry, I will walk you through, break it down shotgun style for you today. So we're going to go just fine together. We'll walk together on this thing.
I'm former Air Force, so don't try and fly over me.
I knew he was going to come with something.
See? That's the guy I got to
I
worry
didn't
about.
disappoint you, huh? Okay.
That's it.
It's always in the air. We're on the ground. It's all right. He's a filet mignon guy. We're like Chuck Steak over here, but it's
There you
okay.
go. There you go. All right, let's get rolling with the Scott.
Scott, are you on the line?
I am. Good afternoon, everyone.
Hello.
Good afternoon.
You can hear me okay, it seems?
Yes, we
Yes.
can. Loud and clear.
Awesome. Glad to hear it. I'm coming to you this afternoon from Philadelphia. We had a team meeting here, so I just wanted to make sure the sound quality is up to par since I'm in a different world than I normally am. How much time would you like me to take this afternoon?
What are we discussing for the profiles?
This is the review of the operating portfolio that we manage for you. I'm part of PFM Asset Management's.
Scott, this is Wendy Colazzo. If I may guide you in, obviously for the
Sure.
agenda, we have the market update, the portfolio review, and then the account summary. If we could keep it at 30,000 feet and give them a good review on it, about 10 minutes is what we've, 10 to 15-minute review, and then let them decide if they have additional questions to ask.
Perfect.
It seemed to work better for them.
Perfect. Great. Thank you, Wendy.
Thank you.
So with that in mind, why don't we start on page 4, because it does give a nice 30,000-foot level of where the economy sort of stands and where I can. I'll provide some current data points, and then we'll get into a review of the portfolio and just, again, as Wendy mentioned, to see if there's any questions or if there's any place you'd like to go from there.
Hey, Scott, hold on
So
just one
looking-
second. Scott,
Okay.
I just want to make sure everyone, it's on this packet here.
Yeah, that's what
It says PFM in the top left, and I guess he said page 4.
Yes.
We have it on the screen in front of us, but just I want everyone to have it ready. Go ahead, Scott.
Okay, perfect. Thank you for your help. So again, high-level overview of the economy and where things stand today. You can see what we're seeing during the second quarter and into the third is economic conditions characterized by persistently high inflation. We have the largest 12-month increase, year-over-year increase in June of CPI since 1981 with a reading of 9.1%. We've seen declining consumer sentiment as a result of that, some slowing economic and increasing recession probabilities, more aggressive Federal Reserve monetary policy tightening. So the Fed lifted the federal funds target rate 3 times in the first half of 2022, March, May, and June. And then we got a result today of another increase of 75 basis points. So the first 75 basis point increase came in June. It was the largest hike we've seen since '94. But they followed that up again today with another 75 basis points. So the Fed funds rate now stands at 2.25%, 2.25 to 2.5%, I should say. The range is 2.25 to 2.5%. So it was a unanimous backing from the member Federal Open Market Committee. They've now actually raised rates since March as much as they did between 2015 and 2018. So again, the effort is to bring inflation in check. They're really fighting inflation now is their main goal. We've seen rising yields and decade-high mortgage rates. So during the quarter, the 2-year Treasury note was up about 0.62%. The 5-year note was up about 0.58%. 0.58%. And I point out those two treasuries mainly because that's sort of the sweet spot for our client base. The majority of the assets we manage kind of fall in that part of the treasury yield curve, that 2 to 5 year range. And so seeing rising rates is not ideal for fixed income investors at the time, but over the long term, rising rates are a good thing because it equates to more income to the portfolio, and income is a key driver of total return for fixed income investors. So there is a little pain in the near term as interest rates rise, but you are and will be rewarded for it over the long term. So that's sort of the backdrop. Again, for the economy, very high level. But let's see how that has impacted the portfolio.
Scott, before you go on, could I ask you a quick question?
Sure.
Are there
Absolutely.
any other steps the Feds could make besides this continued increase in the interest rate? Or you project or see other steps being taken that would fight, address the issue of inflation?
Well, one of the things that they are doing, and thank you for the question, one of the things they are doing, maybe not so much to fight inflation, but definitely to bring their balance sheet a little more, I should say, in line with historical levels. It's gotten so high as a result of the most recent recession and the stimulus that they've thrown at the economy. They are starting to allow their balance sheet to run off through Treasury maturities and agency mortgage-backed security maturities as well. I'm sorry for the background noise. To the tune of about $95 billion. Starting in September, it'll be at about $95 billion a month. They're not at that level yet. They're sort of ramping up, but they'll get to that level in an effort, again, to reduce their balance sheet and take some of that liquidity out of the market. So it can act sort of as a tightening. When they're putting the money in, they refer to it as quantitative easing. Now that they're removing that, they kind of refer to it as quantitative tightening. So it can have an inflation fighting effect, but it's not typically what they do to fight the inflation. Typically what they're doing is, again, raising the federal funds rate.
Okay,
So that is something that they are doing right now.
thank you. Sounds like quantitative squeezing, yeah.
Yeah. Or you could call it that, I guess. So,
Thank you.
is that helpful, though?
Yes, please, yes.
Okay, great. So I lied. Before I get into the portfolio statistics, let me just stop on pages 19, 20, and 21. These serve as our, we call it an account summary. I like to refer to it as a compliance summary, because what we show here are the max sector allocation limits are referenced in the gray bars on this chart. The blue bar, blue shading, is the actual portfolio allocation. So the gray, again, is the amount permitted by the city's policy. The blue is the actual allocation. And you can see you're within the parameters set by your policy from an allocation, sector allocation limit. Starting to get a little close on the Florida Prime Fund, that local government investment pool, but again, you're not breaching that limit. If you go to 20, we plot the max maturity by sector, and again, the blue represents the actual allocation. Again, no concerns from a compliance standpoint in breaching the max maturity limits. And then page 21 is the issue diversification page. So again, looking at allocation at sector level, at the individual issuer level, and then also looking at the credit ratings from S&P, Moody's, and Fitch. And again, no compliance issues on this page either. So your individual issuer limits are roughly 5% per issuer. You can see we typically are not taking a position that high in any one name. We prefer to diversify. That issuer limit doesn't apply to Treasury, as you can see. But again, across ABS and corporates, we tend to keep that allocation well below the max limit of 5%. And again, no issues from a credit quality standpoint either. Any questions around the compliance summary?
No,
Okay,
sir, we're good.
Great. So let's go to 23. Let's look at some of the statistics, and then we'll get to performance, which I know is really what you want to talk about and see, although it's not pretty, but it's important that we review it. So we look at page 23. You see the total market value is $154,637,000 as of June 30th. The duration of the portfolio stands at 2.22 years. Duration serves as a measure of interest rate risk in the portfolio, or the interest rate sensitivity of the portfolio. So if you think interest rates are going up, which they have been doing, you want to have less interest rate sensitivity in your portfolio. And you can see that evidenced in the fact that the portfolio stands at 2.22 years and the benchmark at 2.52 years. So the portfolio has less interest rate sensitivity than the benchmark. And that will serve you well as interest rates rise. You're not going to lose as much as the benchmark in this case. The yield at cost on the portfolio stands at a 1.17 today. And then you can see how much interest rates have moved by looking at that yield at market figure, which is a 303 as of June 30th. So yield at cost is what you're actually earning on your portfolio. It's what we purchased the securities at. If we were to be able to go out into the market today and replicate this, you would actually earn 3.03%, just to put those two numbers into perspective. So again, interest rates have risen dramatically since we started investing this portfolio for you. Now, again, the good news is as maturities occur, as interest occurs, that money is put back to work normal environment, right now we've paused purchases with everything you all have going on between the city and Toho water. But we would, if in a normal environment, we would be reinvesting those monies at higher yields. And again, to my earlier comment, that would serve you quite well over the long term. So again, a diversified portfolio, if you're looking at the upper right corner, you see the sector breakdown. High credit quality, overall credit quality portfolio is AA, and that's referenced in the lower left-hand corner. And then I talked about duration already, but we give you a little breakdown of that duration number in the lower right-hand corner. How do we get to that 2.22 years? You can see that in the blue bars referenced in the bottom right. So let's fast forward to page 24. And this is our performance page. There's a lot going on here. We show you earnings in dollar terms. We show you earnings in percentage terms. I'm going to focus on the percentage terms first, which is at the bottom of the page. And your portfolio total return is in that blue shaded region. We show you the most recent 3 months ending June 30th and the most recent 12 months ending June 30th. And then since inception out to the far right. And that since inception is March 31 of 2021. So, not good numbers in absolute terms. The relative numbers look much better going out longer term, 1 year since inception. But I know it's hard to get excited about relative numbers when there's a negative sign in front of them. However, I want to stress this because it is how we add value to our clients. We try and outperform the market in both up and down markets, but more importantly in down markets. We want to give back less than the market is giving. And we've accomplished that over the 1 year and since inception time periods, outperforming by 39 basis on a gross of fee basis and outperforming by 32 basis points on a net of fee basis. And that's the green region you see on the bottom of the page. So, and again, I'm speaking to the 1 year numbers. On the since inception, we've outperformed by 27 basis points or 0.27% and 19 basis 0.19% on a, again, gross and net of fee basis. For the most recent 3 months, not as good a job as we'd like here, underperforming the benchmark by 4 basis points and 6 basis points respectively, down negative 0.85 versus the negative 0.81 for the benchmark, and then negative 0.87 net of fees. So that rising rate environment that I spoke of earlier worked against us. Diversification of the portfolio actually worked against us, where corporates and asset backs actually underperformed treasuries during the quarter. So, what helped was that shorter duration did actually help performance to some degree, but it's really diversification that worked against us for the quarter. Let me stop. I'm afraid I may have gone over my 10 to 15 minute allotment, and I apologize, but let me see if you have any questions. I've thrown a lot of information at you in a short amount of time.
Question for you, this increase that they've announced today, will this continue then to have a continuing negative impact on our accounts?
Well, I think a lot of the rate increases are already seen in the marketplace. On the short end of the curve is where you're going to feel that rate increase more. And I say the short end I'm talking inside of 2 years. So the answer is yes and no, depending on what part of the portfolio you're talking about. The shorter part of the portfolio, yes, it's going to be impacted by the rate increase today. the longer end of the curve, I think you've seen a lot of the rate increase already priced into the market. So it just depends on what part of the curve in the portfolio it very well potentially could impact total return. Yeah, interest rates are going to continue to be a headwind. I think the Fed is going to continue to take action. There's 3 more meetings this year. I think you'll continue to see them take action, and that definitely is going to serve as a headwind for fixed income investors. I wish I had a better story.
So do I.
Yeah, it's not the past few quarters haven't been fun meetings to deliver to our clients. Believe me, we want the best for our clients, and it's not fun delivering negative returns to them.
We
Scott,
feel your pain.
Sorry.
No,
Sorry, Mr. Wood.
that's it. Thank you.
Scott, I wanted to add, if we could, some, maybe historical references that I think everybody here, would find useful. I think that, I don't know if you can add any value to this, but back in 70s and 80s, if we recall, inflation rates were at 14%, not 9.1. And this is exactly what our economy did. Inflation rates went up. Our fixed income individuals weren't investing, right? They stopped producing more money, right? And they started doing restrictive. And we fared well. Again, you know what I mean? It's just this awakening from, I think the supply chain, right? Our consumers are using their excess cash a little faster than we can produce. But our country has been through this. Our municipality has been through this and felt that effect at a much larger rate. And I don't know if you have anything additional to add, but just wanted to give reference of a lot of hair on fires, but historically we've been here way worse. And we projected a mini recession, and we've been faring for that, right? We haven't felt the full effects, but I think that is why, Scott is in his business, and we try to do ours to kind of say that we are organically going with the punches right now. So just wanted to add a little history to that.
No, that's a great point. I think it's always important to recognize that we have been in similar situations before, and I'd say the United States, the economy has always bounced back, maybe bigger, maybe stronger, and I think we'll do it again. We'll bounce back again, and we're going to get a reading or initial 2Q GDP reading tomorrow, as a matter of fact, and so we're going to learn quickly tomorrow whether we've truly entered a recession by the definitional term of recession, which is 2 consecutive quarters of negative GDP growth. So we'll get some answers tomorrow on where the economy really stands. And I think people really know where the economy really stands, but we're going to get a data point to tell us that tomorrow. But I agree with your comments completely. We've been here before. We'll get through it. We'll come out stronger on the other side, hopefully.
All right, thank you.
Any other questions?
It seems that,
Thoughts?
Yeah, hold on, one
excuse
more.
me, it seems that most of your investments are very small. Does that change over the quarters, or does that pretty much stay like, it's only like 17% of the allocations are in the majority of your investments?
Yeah. So a lot of that was just driven by the large infusion of cash into the portfolio. So and then what we did is put, as you can see, put that into treasuries, and then as we saw opportunities present themselves, then we put that money to work. So that's why you only see about 17% in other asset classes at this point, because we consider ourselves relative value investors. So we are, again, we're not going to rush into a sector and put that new money to work just because you gave us new money. We're really going to be mindful and thoughtful about making the purchases on your behalf. And the reason it's only at 17% is those opportunities haven't really presented themselves, given the headwinds that we've talked about, and that's the rising rate environment, the slowing economy, some of these sectors that we like to utilize to diversify just not presenting real good value for us right now. So in a different world, in a different environment, I think you would have seen more of that money put to work by now.
If I may reference also, our investment policy puts us in a conservative level as well, you know what I mean, for those
True.
brackets as well. So, it's
Yeah,
kind of like we're
yeah.
getting ready, we're on the ramp, but, we won't want to put that cash in circulation if we don't see that diversification and that outcome. So that investment policy protects the stewardness that we have, towards the money that is not really ours, it's the residents' money, and we invest tactfully, and then also, of course, with the economic wind, and change, and, Scott's, mind and brain and what he knows of the industry. So just some factors that add to that.
Yeah, I was just wondering if that fluctuated at different times,
Well, I guess the short answer would be we hope so, that you'll see that fluctuate now as we put cash in play, and, we get we see a little bit more vitality. So, and Scott could, has spoken to that.
Okay.
Yeah.
Thank you.
You're welcome.
Any other questions? All right. Thank you, Scott.
Thank you. Thank you for your continued business. We really appreciate it. If anything comes up after I leave today, please don't hesitate to reach out to us. Wendy and Donna and Jeff know how to reach me. I'd be glad to address anything after the fact.
Awesome. Thank you so much.
Okay.
Have a good evening.
Thanks. Have a good evening, everyone.
You too.
You too.
Bye-bye.
Thank you.
If you guys do speak, if you could bring your mic closer
Okay.
so everyone can hear. All right, next, Jeffrey, you're up.
Can you put up my slideshow, please? He's got to change the slideshow. All right. So this is our normal quarterly meeting where we go over basically the performance of the city for revenues and expenditures, kind of see where we're at the end of each quarter. So this will be as of June 30th. And this just tells you the purpose of the presentation and so forth. All right, so we start with the top 10 revenues, and I'm not going to go over these one by one since the next meeting, the budget part, is more the fun part, but normally we'd go through these individually. But so what we're looking for here is we're through 75% of the year as of June 30th, so anything under 75%, I'll just address those. I'll also make a note for the new members on the ad valorem taxes. We collect about 80% of those in the month of December because people pay to get their discount. So we've about collected 100% of our estimate. So the two that are under 75% are public service utility taxes. Those generally run higher in the third and fourth quarter. Thanks for running your air conditioner, so the tax portion of your bills are higher. So we would expect that to catch up over the next few months. And the county gas taxes, that payment runs about a month behind. So this does not include June, and it's about $131,000 per month is what we're getting at this moment. So we're fairly close to where our estimate was. And as you can see, impact fees.
I have a question for you.
Yes, sir.
And again, I don't know if I've heard on the news or whatever, they're talking about freezing gas taxes, is that going to play any factor into these numbers?
The local surtax charge, they're going to stop it for a month. They haven't determined it.
Yes, it could. So we could theoretically lose $130,000 out of, they haven't determined when that's going to happen or if for certain that's going to happen, but it would be a small, 1 month is all it's supposed to be. So as you can see, the impact fees are well over 100% of what we estimated. So those are all the impact fees. So that's parks, police, fire, mobility, water, sewer, and sanitation, all rolled into there. So that's strong growth continues in this area. So that's why your impact fees are so high. So overall, we've collected nearly 100% of our budgeted revenues through only 75% of the year. So strong performance continues. Any questions on these? And for the new members, I can give you my card after this meeting is over. If you have any specific questions, feel free to email me and I'll get you whatever you need. And as Chairman Reinhardt mentioned, if there's certain things you'd like to see during the meeting, this is not like a set presentation. Honestly, this is what they were doing 2 years ago when I arrived, so I just kind of continued with that. But if there's other things you'd like to see, I'll be more than happy to do that for you.
If I may. I'm going to add some color to the revenues, just some information to have as this platform over to the budget and kind of set some parameters. Ad valorem, we traditionally set on a budgetary level at 96% of collection. So when you see a 99.5, that's significant, right? Because we are trying to be conservative. But in the long run, as it relates to COVID, you'll hear those words and recovering economies, right? Ad valorem is one of those that doesn't get as affected as quickly because it's backward, right? It's back, you know what I mean? So you'll see things in the budget related to this that'll say things like low interest rates, and you'll say, Wendy, you're crazy. We just heard high interest rates. Well, you got to remember valuation happened backward, right, for this year, right, coming year. So things to factor. In the impact fees, let's not get too excited, right, because yes, 136.3% of impact fees, but we are 2.5 to 3 years behind in projects, and that's going to come over in fruition right now as we get more streamlined. So that money is going to be used as quickly as it came in, you know, for the existing as we catch up, because we can't go in the rears, we're going in the future. So impact fees are also taking a stab up as we pass ordinances for Parks and Rec, police and fire. We've added capital, we've added inflation costs, and let's hope we've done our homework to try to capture this as best as we can. So some factors to that beautiful 136.3%. Also, in the infrastructure sales gas tax, a phenomenal thing happened in state legislature and law that I want you to factor in, which why we're anticipating higher, yet we're conservatively budgeting lower, is that there was a great thing that passed. When you keep ordering that beautiful Amazon orders that are coming to your house, and it happens in the county because that tax happens on the first $5,000 of things of that, the law just changed and they can now tax that on the sales of the local surtax charge. So great news, because before we couldn't capture that. So when you get that beautiful smiley box now, we're getting rev because of it after our appropriations go through and we share that tax. So those are the fun facts and highlights. And then OUC interlocal, we expect a good performance of that with 200 to 300 clients getting added. Additionally, 275 roughly is what we're getting. It's very significantly healthy, and we're looking to project about $9 million this year. With the Stevens Plantation sales of properties, St. Cloud Interlocal was what we used to pay for taxes on those properties. And with the selling of that, we don't have that expenditure no more, so the general fund expects those items, So, like I said, just tying in some things for you and some fun facts that affect what these numbers look like.
I am not going to tell my wife about the Amazon thing,
Well,
even though it would help us, but
You're-
I have my limits.
You are a man married 60-plus years, Mr. Hoagland. You know best.
Wisdom.
With,
So the next slide is the major fund revenues. Again, we're through 75% of the year, so all of those are at 75% or above. So as Wendy mentioned, we always try to be a little bit conservative. So, we hope to be at or slightly above our estimate for revenues in all cases, because we don't want to overestimate and then undercollect, because then that causes budgetary problems. Any particular questions on any of these fund revenues?
No, sir.
If not, we'll go to the major fund expenditures. Again, these numbers do include encumbrances, and so we're through 75% of the year, and this is how much percent of the budget in the far right column each of the funds have expended. Generally speaking, in the general fund, we run about 82 to 85% spent of what we actually budget. The primary reason for that is we budget as if we're going to fill every single position and keep every single position filled throughout the year, which, unless you're in the finance department, that never happens. We always have vacancies, but, we are getting staffed up. Like, I think we have 3 new police officers starting on Monday, so that gets us down to only 2 or 3 vacant police officer positions in the whole city. Generally, the reason for that, and whatever we budget for city council contingency, hopefully nothing unexpected happens, so we generally do not expend that either. So all of these are in line. The sanitation fund is a little bit above where we would expect them to be, and there's good reason for that, is because they've had to spend a lot of money bringing their fleet up to fully operational. We have a lot of aging trucks. We have some new ones en route, I believe, where they're expected in November, December. So in the meantime, it gets very expensive keeping those large side loader trucks going. So, and then in the meantime, we've also had to rent some trucks there. So we have that expense that we would normally not have, but they're not far out of bounds. Any questions on those? If not, we'll go into our major fund surplus and deficit. This excludes encumbrances, so this is cash. This is revenues in the door, expenditures out the door for each particular fund. So as you can see, the general fund through this period of time has received $2.9 million more than it spent. Again, we get a lot of our revenues from ad valorem in December, so at this time of year, we generally are spending more than we're receiving in the general fund. Each payday runs about 1.3 million in the general fund, salary and benefits. The water fund is actually lost money, so to speak, but that's just because they're ramping up expenditures with, Toho taking over management. So they've created a lot of new projects, and you're going to see a lot of things happening there. So that's the reason for that. The only other one in the deficit situation is the building fund, and you'll probably continue to see that as we meet. And the reason for that is the atrium expenditures. The atrium is funded in full by the building fund, and as those expenditures start coming through, you're going to see a deficit there, but that's actually like a good thing, because for the new members, we were actually above where we should be for fund balance before we encumbered the atrium. So now basically we're spending the cash down. We're good for fund balance now. We're just spending that money down. The atrium was $3 million plus $3.4 million, in case you were wondering. Any questions on that?
Are we going to have a little more detail on Toho water conversion, and when you're saying trying to get all these different projects before what they take over, or are we going to go in a little more depth on that whole?
Yes, sir. I had a kind of a disclosure of it, on it. We still gave a picture, we will have an overview where, because it is inclusive, we're running a parallel budget. To summarize for you, the capital plan was streamlined with what we had existing and projected out 5 years with the direction of Toho and what they wanted to do in their vision. So that has been done. It is not in budget for us because the magnitude of what that capital plan looks like is something, that we couldn't put into budget. But operationally, what will happen is October 1st, we've ran parallel budgets so that when they cross over, like personnel is due to crossover, contracts, encumbrances, we are giving all those details by, we're going down the balance sheet and doing assets, liabilities, equities, and everything of that nature.
You say that's October 1st?
Potentially. October 1st is a Saturday right now, so we'd like to leave people at home on a Saturday, so we're going to probably go October 3rd, maybe 4th, and then the first transitional payroll will be October 9th. I believe so, 7th or 9th. So we're determining those haven't been laid out fully, but that is the projected plan. Overall, like I said, we're just kind of running what you would call, I don't want to call it a mock budget, but it's a transitioning budget in the event that, for example, a vendor forgets to bill us, October 15th and we get a bill, right? I mean, we might not just transition all the books just yet by then, but more importantly, who's pay it, so we have some budget to take care of that if we haven't fully transitioned everything. I mean, full transition of the utility as far as books and closing won't happen, through October or anything like that. We're still determining all those things.
Okay.
So,
Thank
but
you.
they will have full management of the utility.
Thank you.
Yep.
The next and final slide is the general fund departmental expenditures. So that's just a breakdown of the various departments and how much they've expended this year. This does include like encumbrances, purchase orders that haven't been paid out yet. Again, we're through 75% of the year. So as you can see, we're generally below that. As I indicated earlier, we spend on average about 80 to 85% of departmental budgets each year. The main reason for that is just the turnover and vacancies in the various departments. So the departments that have low percentages here, those are generally the ones that have had the highest number of vacant positions, throughout this year, the highest number of turnover. Also for expenditures, we budget on not exactly worst case scenario, but we budget to ensure that we have everything covered. And sometimes those things don't happen. You might budget for temporary assistance, like in the case of having vacant positions. And if you don't have any vacant positions, as we do not in finance, we would not use that funding. And then at the end of the year, funding not encumbered basically goes back into the pot, so to speak, goes back into fund balance, and then that's where we get the $7.5 million we're using for next year in order to balance the budget. We're pulling that from our fund balance, our pot, so to speak. Any questions on any of those? Anything I've talked about? So this will be like our regular quarterly meeting. Again, if you have any specific questions, I know this is a lot to learn. Probably took me almost a year to really grasp it. So take your time. And that is it for my part.
Any questions? All right. As I said before, we're going to be transitioning into meeting number 2, which is our workshop for the budget. Then we'll transition after that to the final budget review of the workshop and go from there. We are probably going to take a break. I'm assuming once we're done, we have, they provided some food for us, so looking at the time, maybe we'll reconvene here about, let's go 5:20, give us a little more than 15-minute break. They'll meet us back here. We'll go back there, and I have water and other things for us, so we'll come back in here. We'll start right at 5:20. Do I have any comments from the audience? If there is none, no other comments here, meeting adjourned.